I want to start this video by being very clear about something. I feel genuinely optimistic about Ottawa real estate in 2026. Not in a hype-driven way, not in a prices are about to explode way, but in a grounded, fundamentals-based way. Because when I look at the data, I look at reports from CMHC, TD, RBC, the real estate board, and when I look at how real people are behaving on the ground, 2026 looks like a year where the market quietly moves forward. Prices move modestly, sales increase before confidence fully returns, and opportunity shows up for people who are prepared. That's exactly the kind of market Ottawa has always rewarded. Everything I'm about to share is my opinion. It's informed by statistics, informed by economic forecasts, but it's also informed by conversations with buyers and sellers every single week. And the biggest theme for 2026 is this: the market already adjusted. Now it starts to move, but quietly. Let's talk about pricing first. My expectation for 2026 is that Ottawa home prices increase roughly 2 to 4% over the course of the year. Not evenly, not across every property type, and not in a way that grabs headlines. This is not going to feel dramatic like it did during the COVID years. Most people won't notice it in real time. But when you look back at the end of the year, you'll realize that the prices have moved up in your community. And I think that that movement starts to become visible around April. Not January, February, the early spring, but April. And here's why that matters. In Ottawa, activity always leads confidence. Sales start happening first, and then people feel more comfortable. The prices will respond after. That's the order. It's always been that way in our government city. So if you're waiting for headlines to tell you that prices are rising again, you're probably going to be behind the curve. Now let's talk about sales volume, because this is one of the most misunderstood signals in the market right now. I expect sales volume to increase before the average person feels confident again. In the first quarter of 2026, I expect sales to be up roughly 5 to 6% year over year. The second quarter will be slightly higher than that. And while it's still early to make definitive calls on the back half of the year, all indicators are pointing toward continued positive momentum into quarter 3 and quarter 4. This is a 15 to 20% sales volume growth year over year. Not explosive, but steady, healthy movement. This aligns closely with broader economic outlooks. RBC and TD have both been signaling stabilization phase in the Canadian economy rather than a continued downturn. CMHC continues to point to strong underlying housing demand in supply-constrained cities like Ottawa. What slowed the market in 2024 and 2025 was not lack of demand. It was hesitation, and hesitation doesn't last forever. Here's the important thing to understand. People don't wait for confidence to act. Confidence typically comes after they've already acted. Markets move while people are still feeling cautious, and this is exactly where we're heading into 2026. Now, I want to talk about interest rates because this is where most conversations still get stuck. My view for 2026 is that rates will largely hold steady through at least the first half of the year. This is especially true for variable rates. I'm not expecting aggressive cuts early on, but I'm also not expecting any increases. Honestly, this is exactly what the market needs. Housing markets don't require falling rates to function. This often leads people on the sidelines as they think they might get a lower rate in the future. Housing market requires predictability. Stability gives people permission to plan. Planning is going to lead to movement. What I'm seeing right now is not fear around rates. It's acceptance that this is where we're going to be. People have adjusted. You've recalculated. You're no longer waiting for rates to return to the 2021 levels because that likely will never happen again. They're figuring out how to move forward within the environment that we are currently in. And that shift in mindset is incredibly important because it changes behavior. Now, I want to talk about inventory because this is one of the most misunderstood topics in Ottawa real estate right now. You'll hear people say, there are more listings now, inventory is high, buyers finally have the advantage. On the surface, that sounds reasonable, but context matters. Here's the part that almost nobody talks about. Ottawa's current inventory levels are roughly in line with where they were in the early 1980s. Not higher, not extreme, roughly the same. This comparison matters a lot because in the early 1980s, Ottawa was a very different city. Population was significantly smaller. There were fewer households overall. Household sizes were larger. There was more multi-generational living. Immigration levels were significantly lower. Demand pressure was a lot lighter. If we fast forward to today, Ottawa's population has grown dramatically. Household formation has accelerated. Immigration targets are much higher, and the average household size is significantly smaller. This means we need more homes per person than we did did in the 1980s. So when people hear inventory is similar to the 1980s and assume that that means oversupply, that's the wrong conclusion. What this actually means is that even with more listings than the last few years, Ottawa is still extremely undersupplied relative to the population. This is why home prices didn't collapse in 2025. This is why increased inventory didn't break the market. This is why I don't see a major downside scenario for 2026. What we experienced in 2025 was not excess supply. It was normalization from an extreme shortage that we had the previous years. That's a huge difference. Shortages don't disappear overnight. They get compressed. They turn into pent-up demand. And pent-up demand, it doesn't vanish. It waits. That's why when the activity starts to return, which we're already seeing early this year, prices don't need to spike dramatically. They just need to move quietly upward, and that's exactly what I expect to see. Now let's talk about the biggest driver of 2026, and it's not rates, it's people. Specifically, it's life cycles. The average homeowner moves every 5 to 7 years. That single fact explains more about housing markets than almost anything else. Think about how many people bought homes in Ottawa in 2019, 2020, 2021. That was a massive wave of buyers. Those homeowners are now 4 to 6 years into home ownership. They're hitting renewal periods, thinking about space, maybe have kids, thinking about schools, lifestyle. They are starting to run their numbers. A lot of those 2021 buyers locked in mortgage rates that started with a 1. The renewals will not look like that. Even if the rates do happen to come down modestly, their payments are going to be higher. Doesn't make them forced to sell by any means, but it does make them have to make a decision. They will be asking questions. Do we absorb? Do we stay and absorb this? Do we refinance? Maybe extend the amortization? Do we sell and reposition? Do we move now instead of later? If we have higher payments, maybe we should upsize. That kind of pressure creates movement, not panic, but movement. This is why I believe transaction volume increases in 2026 even before the market feels good again. So let's talk about another group that's entering the market in a much bigger way this year, the baby boomers, specifically ages 61 to 72. This group is incredibly important to understand because they behave very differently than younger buyers. The vast majority of this group is mortgage-free, almost 96%. We've already seen the data showing that most sellers in this age range don't carry the active mortgages, which means they're not rate sensitive in the same way that first-time buyers are. They're not payment-driven. They are extremely lifestyle-driven. They're downsizing by choice, not necessity. And that distinction changes the market. Boomers are not looking for the cheapest option. They're looking for low maintenance living. They're looking for comfort. They're looking for security. They're looking for something that they can lock the door and leave on vacation when they want. This is where the condo story changes in 2026. And it's very important to be extremely specific here. Not all condos will benefit. The condo market does not move as one. What I see happening is a split. Larger, well-built, probably the older style 2-bedroom condos in good locations will begin to perform much better, especially the ones that are more luxurious and catered to downsizers. These units will see an increased demand, better pricing, shorter days on market, more firm offers. But at the same time, the small micro condos, a lot of the brand new buildings that have 500 square foot units, studio units, tiny 1-bedrooms, more investor focused layouts, those will remain unchanged because the boomers are not downsizing to live in a small box. They're looking for a new lifestyle. They want something with space, but convenience. And understanding that difference is critical. Now, here's where everything connects. When the boomers downsize, they don't just buy condos. They sell detached homes, often mortgage-free, large homes where they've built their families, oftentimes very well maintained, in established neighborhoods. This creates an opportunity for the upsizers, for families, for multi-generational buyers who have the budget to purchase these larger homes. This is how the market actually moves, not in isolation, but in chains. Condos absorb downsizers, detached inventory starts to increase, and upsizers finally have options. Equity starts to get repositioned and wealth transfers start to happen, not just through inheritance, but through transactions. This is why I believe detached homes will remain extremely resilient in 2026. They won't explode in price, but they won't collapse either. They're supported by real demand. Now, layer on another trend that continues to grow, multi-generational living. This is not a short-term trend. Go back 40 years, it was common. We lost that a little bit, but but it's coming back. It's structural. More families are planning long term. More buyers are thinking about flexibility. Parents moving in later. Adult children are staying a lot longer. Ottawa housing stock supports this way better than many cities. And this is why space continues to matter. Flexibility always holds value in normalized markets. Now, I want to be very clear about this. 2026 is not a year to wait on the sidelines for clarity. Clarity already happened in 2025. 2025 reset the expectations, corrected behavior, separated strategy from speculation. 2026 is about execution. Prices move quietly. Sales increase steadily. Opportunity shows up before confidence feels obvious. This is how the Ottawa market works. They reward preparation, not reaction. So here's my final outlook for 2026. Quiet price growth in the range of 2 to 4%. Sales volume increasing before confidence fully returns. Stable interest rates, especially on the variable side. Strong downsizer activity. A little bit of a changing condo story for the larger units. And resilient detached homes. Real opportunity for people who start planning early. This is going to be a great year for Ottawa real estate. Not because everything is perfect, but because the fundamentals are strong. If you're thinking about buying, selling, upsizing, or downsizing in 2026, the best thing you can do is build a plan now, not when the market feels obvious and everybody's talking about how hot it is. If you want help walking through your numbers, your timing, or your options, reach out. I'm always happy to talk strategy. And if you want more honest, data-driven market breakdowns like this, subscribe to our channel. I'll be covering the Ottawa market all year long.